Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. In today's video, I'm gonna talk about two different stocks that I have been purchasing lately. One is a brand new stock to the portfolio, and the other one is actually existing one that I've been buying in the last couple of weeks. Before we get to the financials and look at the details of these companies, why I'm buying, what I bought so far, and what the plans are for going forward, and so on, I would love you to just give this video a like. It really helps the channel. Okay, the channel's growing, a lot more people are actually joining the community, and the more the better, obviously, because we now have people that are asking really good questions, people that are asking different types of questions, and we can all benefit from that. So it would really be helpful if you can just like the videos and subscribe to the channel. If you are not, there's about like 40% of the people that watch these videos are not even subscribed. So I would really appreciate if you can subscribe to the channel, share with your family and friends. All I'm doing here is basically sharing my journey with you guys. Okay, everything you see here is real money. This is not made up. This is not a spreadsheet. This is my trading 212 account. I also have a Freetrade account. Just one stock there, Salesforce, is not doing great at the moment and it's down quite a bit. But I've been transparent and I will remain transparent, inshallah. Okay, so I hope you enjoy this kind of video, and if you do, please give it a like. Right, so the first companies, the reason I started actually basically buying these companies the last couple of days is because the market is actually down quite a bit. Today it looks kind of okayish. Energy is probably the one that is actually hit the most, but when you look at last week, I think it was absolutely crazy, especially for tech companies. But generally, when you look at, say, for example, last 3 months, it doesn't look that bad at all. It genuinely doesn't look that bad at all. Okay, even I was surprised Qualcomm for the last 3 months, not Qualcomm, Broadcom is actually up 10%, whereas Qualcomm is down about 20%. That's crazy. Nvidia is down about 16-17%. Adobe, another company that I own in my portfolio, for basically right now just about $400 per share. I think I started buying when it was $600. So I'm down quite a bit in these companies. But hey, what I'm doing right now is just holding on. I'm actually focusing more on the companies that are really down, that are not in the tech sector at the moment. So because like I said before, I want to focus on quality companies, obviously, but at the same time, I want to make sure I have a balanced portfolio, because right now I've got more money into tech than any other sector. So that's quite just worrying a little bit, because if tech carries on doing that, then I might actually lose a lot of money. So I'm putting a lot more money into the industrials, the consumers, discretionaries or consumer defensive, and healthcare and so on. So just to kind of balance things out. Right, so let's look at the first company that we added to the portfolio, and that is a brand new company, and that is in UPS. UPS is a great company. It has been on my watch list for a very long time, but now I've got the opportunity to add to my portfolio. It has a market cap of $162 billion, so this is not a small company, and currently trading at $186 per share. Right. And when you look at this, it's down 12.5% a year to date. And this is probably one of the reasons that attracted me. But when you look at it for 1 year, okay, it's about 6%. And when you look at the last 5 years, okay, so imagine if you bought this in 2017, right now you would be up 73%, which is very, very good. And this is the kind of thing that attracts me to the basically stock market. Yes, you're not going to get that every single year. You might have a bear market for a couple of years and you might not make enough money, but that's fine. But on average, if you can get that 7 to 10% every single year, which is the S&P 500 returns, that's absolutely brilliant. So it's down quite a bit at the moment. So yeah, the year to date is actually down 12.5%. And this is why I think it's fairly valued, and this is one of the reasons I've included in my portfolio. It has a beta above 1, PE just about 12.66, okay, and EPS is absolutely brilliant. They have a dividend yield of 6%, 3.2.5%, or they pay you just over $6 per every share that you own in this company. Right, let's have a look at the financials. Okay, so we're looking at income statement section first. And when you look at that, you can see from 2018, it was making in total revenue was about $71.8 billion. on 2019 it went down it went up about $3 billion, and then 2020 it actually went up $84 billion, almost $84.6 billion. So it's actually increasing in the right directions. And then basically 2021 it was $97 billion. Now the last 2 years is actually different because a lot of things has happened. COVID has changed a lot. So because everybody was at home and ordering stuff, that's probably one of the reasons why this is actually a massive jump from 74 billion to almost basically added $10 billion. And again, another, what is that? Another 10 billion, $11 billion just the following year, which is actually quite high. So I think that's not sustainable. So that's definitely going to come down into basically in 2022. In terms of cost of revenue, again, more or less the same. It's gone up just this last year. In terms of gross profit from 12.4, let's call it 12.5 to right now $20.58 billion, which is absolutely brilliant. Now, that's their top line. So what is happening to the bottom line? Are they actually making a profit? And when you look at this is absolutely amazing. Okay, 4.7, 4.4, 1.3, so that's 2020. They probably had a lot of expenditure there, and then back again $12.89 billion. So it's definitely heading in the right direction. It is a great business. So the top line and bottom line both look amazing. Let's have a look at the debt right now. Right, when you look at the debt, you can see current assets is $24.5 billion in comparison to whereas the current liabilities of 17.5. So they have enough current assets to pay off their current liabilities, which is absolutely fantastic. The next thing we're going to look at is the cash flow here. I think they've got about over $10 billion in cash. Okay, $10.8 billion. So that's about basically healthy balance sheet for me. Now let's have a look at the in terms of the profit margins and things like that. So profit margin is about 13.25. You've got operating margins of 16.72, return on equity 172%. Now in terms of growth, in terms of quarterly growth, you can see about 11.5, and then they have current ratio above 1, which means basically they've got enough money to cover, and we've already seen that anyway in the current ratios. Okay, so that current liability is actually less than the current assets, which is very good. Now, the final thing we're going to look at in terms of Yahoo Finance is the next 5 years, and that's 14% growth. So you're expecting basically this business to grow about, the earnings to grow about 14% this year, the next 5 years, every single year for the next 5 years, which is absolutely brilliant. Sales is not growing as much as I would have liked. It's actually slightly declining. Okay, in 2022 to 2023 is going to decline, and I think a lot of that is to do with the fact that COVID, everyone was locked away, and we've ordered so much things. Right now, world is opening up again. Okay, people will probably start ordering less, and that's expected, and that's actually reflected in the financials. Okay, so when you look at their income statement, from 71 to let's call it 74 billion dollars in 2019. And then 2020 is a massive jump, and then there's another massive jump. So definitely this has to come back down to what used to be before. Okay. One of the things I love about this business is basically they, in terms of shareholders, they definitely care about their shareholders, because the two things they do is they pay you dividend and they buy back their own shares. So then every single year they've increased it. So basically this 2022, they're expecting about over $6 billion in basically dividends, as well as they buying back their own shares, which is very good. Okay, that to me, that is very good. That's a healthy business. And the fact that they've got $10.8 billion, I think it was, okay, that shows basically they've got enough money in the bank to actually cover this. Let's now have a look at if this company is actually a buy, sell, whatever it is, according to Morningstar, because that's important. So it's a great business, but what we want to see is this a buy right now? Okay, and that's the really important question. So it's fairly valued at the moment, $186 per share. That's what the analysts are expecting in Yahoo for Morningstar. It has a wide mode, and capital allocation is about standard. Now, currently trading 168. and the fair value is 168. So it's perfectly placed right now. Okay, if you wait for a little bit longer and you see maybe a drop, again, I think they're reporting tomorrow. There you go. They are reporting tomorrow before the market opens. So that means if they don't impress the analysts, then they might actually go down a bit further, and then that might give others opportunity to actually add to their portfolio. Because if it's fair valued at the moment and it goes down, say 2-3%, 4% tomorrow, then that's your margin of safety, which is very good. But I already started a position, and I'll share that with you in a second. So I am happy with basically the when I started buying, it was actually fair valued. So let's have a quick look at what Simply Wall Street thinks, and that is $238 per share, which is quite, I think it is, yeah, they're a little bit, I don't know. I prefer Morningstar because I think a company like this, I think it's better to be safe, okay? And it's gone up quite a bit. It's gone up quite a bit. And now it's went down in the last 3 months, whatever. But it has been going up for a very long time. So you have to be careful. And margin of safety is what you really need. So just the final thing I want to share with you is the, according to Simply Safe Dividend, is actually their dividends about 69% safe. And they are growing it very fast, which is very nice to see. And finally, what couple of more things. They have been growing these dividends of 23 years. And the last 5 years, they've grown this on average. It was about 6%. Last 20 years, about 9%. So that's quite fast, which is what you want to see. But what they did recently, okay, so recently in February, they hiked their dividend basically increases 49%. They've increased this dividend 49% in just one go. That was amazing. So they must have had a lot of cash lying around and said, you know what, let's give it out. So which is really good. And according to TipRank, it's $239 per share. That's 28% upside. And when you look at all these analysts, a lot of them are saying it's a hold. Okay, so some of them are buy, some of them are hold, but the ones that are saying even hold is still upside of 31%, 15%. So their price targets are way higher than where it is right now. Right now it's trading $186 per share, but they're expecting it to be $265, $216, $245, $200. So it's a lot more higher than where it should be. A lot lower than where it should be, sorry. Right, the next company we're looking at is Stanley Black & Decker. This is an existing position, so I had this in my portfolio before. Currently trading $140 per share, market cap of $22 billion, almost $23 billion. Beta is just a little bit high. Let me just zoom in a little bit. And then the EPS, so you can see PE is quite low. EPS is very nice. And then you've got about 2.17% dividend yield. So that gives you about $3 for every share that you own of this company. Let's have a look at the financials. In fact, before I get to the financials, one of the reasons I'm buying this more is if you look at the year to date, is down 24%. This is a dividend aristocrat. I think they might be dividend king, but I'll check that in a second. But definitely dividend aristocrat. And that means a company that have increased their dividend for a very long time, 25 years or more, right? So 25 years or more to be making money and actually being on creating profit so you can share it with your shareholders, and to be down this much is something doesn't add up. So we'll look at the numbers in a second, but this is one of the reasons I'm buying more. And I'm actually down quite a bit, so I'll show you in a second. The company has loads of different products, okay, mainly tools and so on. So if they've got loads of brands like the Stanleys and Craftsman and Black & Deckers and so on. So if you go to any place where like a Home Depot or Lowe's in the UK, if you go to B&Q, whatever, you will find a product this company owns. They have a lot of security systems as well. Okay, so they are in loads of different types of industries, so they're not relying on just one basically product and so on. Right, so let's have a look at the financials. In terms of their revenue, you can see just almost $14 billion in 2018. Then that's gone up again, that's gone up. So it's actually heading the right directions. Then when you look at their cost of that revenue, more or less consistent. That gross profit is actually also consistent. And then the net income, okay, from the millions to $1.6 billion. So it's actually consistently doing well. So in terms of balance sheet, and again, we're looking for current liabilities. Okay, so when we look at current liabilities of $8.5 billion against current asset, that is, and then against current liability of $8.7 billion. So they slightly, if something happens to the company right now, they will probably will have to use their free cash flow again to, or just get a debt from the banks or whatever. So they are, next 12 months, something happens to the company, they might not be able to finance their debt, which is a little bit worrying. But again, a company this size, that will not happen. Okay, they will be able to finance that with no issues. They're not going to go bankrupt just like that straight away. And finally, free cash flow is not a lot, but is there. Now, one of the things that's happening to this company is, yes, the free cash flow isn't where it should be, but in the last few years, okay, there was almost above $1 billion. So I'm sure because of COVID, something has happened to the business. So $1.6 billion to 144 million. Now that is massive drop. So probably a lot to do with obviously with COVID and that kind of situation. So I'm sure in the next couple of years, in fact, that's what we're going to look at now, is the expectations for this company in terms of earnings to grow about 13%, which is absolutely amazing for a company this old. 13% is absolutely brilliant for every single year in the next 5 years. And the sales from 24 points. So this year, so last year in 2020 was actually quite low, but this year 24.7% growth. Okay, and the year after 2023 it drops back again to single digits. But next, basically this year is expected to grow that double digits, and I'm sure because of that the cash flow will be back to where it belongs. Now looking at Morningstar, you can see 21% discount at the moment. It has a narrow mode at the moment, and again, it's one of those companies. So there are tools that they've created. Other companies can come in, but they don't have just one single product. They've got loads of different types of products. That's why I'm not worried about whether this economic mode is narrow or wide or whatever. And when you look at let's have a quick look again. It is tip ranks actually says $176 per share. Let's see how many analysts are looking at this company. Not a lot of people are interested in this, which is, again, this person thinks it actually should be $222, and that's more than 50%, closer to 60% upside from where it is right now. And a lot of that is because of the projections for this company in terms of sales. Valuation, when it comes to simply Wall Street, again, 45%. That's perfect. $258 per share. Now, this is one of those companies you really have to be careful, okay? If you don't know a lot about the business, and you don't own it already, then obviously do your research and find out. I'm comfortable, even though the cash flow is actually quite low, and normally I would expect at least 2 billion plus to be on the safe side. But the fact that I understand the business model, and I genuinely think, okay, in the next couple of months, next couple of quarters, we will see this company will go back to where it belongs, basically. So dividend safety is 90% safe. Again, that's one of the reasons why I'm not really worried about. Okay, the dividend is actually quite good. Let's have a look at how many years. 54 years. So they are definitely dividend king. And the last 5 years, they grew their dividend about 5% or 6%. And just recently, they increased it about 13%. So they will not have increased it 13% if they didn't have enough cash in the bank. That's just the end of that story. Okay. So yeah, the great company. Let me quickly show you before we move away. Just be transparent. I bought 2 shares yesterday. I had 10 before. I'm down £144 right now. And UPS, again, I'm up just about $3 or whatever it is. I have 2.65 shares. Like I said, it's a brand new addition to the portfolio. And once the earnings come out tomorrow, it might go down a little bit more. I might have another opportunity to actually add. I want to have at least about 2%, 3% of my portfolio in this company. So we'll see what happens. That's all I wanted to share. I hope you enjoyed the video. If you like this kind of videos, please like, subscribe to the channel. Have a wonderful day. Assalamu Alaikum.